Gold is grabbing the spotlight again. Central banks are buying like never before. Technical charts hint at a big move, and experts say gold and silver could surge if the system shifts. But short-term volatility is real, with prices testing key support levels. Let's break it all down. According to Zero Hedge, only 5% of fund managers expect gold to trade above $5,000 by the end of 2026, none over $6,000. Now, looking at that carefully, Zero Hedge highlights just how few professional investors are betting on extreme upside for gold in the near future. That 5% shows that while a small minority sees the potential for big gains, the overwhelming consensus is more conservative. This sets the stage for understanding market sentiment versus market possibility. Rick Rule adds some important context, saying there will absolutely be a time in the next decade where the gold price falls momentarily by 20 or 30 or 40%. That will occur. It's important to understand the arithmetic as opposed to the narrative so that you have the psychological and financial ability to stay the trade. This is a really grounded point. What Rick is emphasizing here is the inevitability of volatility. Markets don't move in straight lines. Understanding the numbers and the underlying dynamics, rather than getting caught up in hype or fear, gives investors the mental framework to navigate swings. Bloomberg reports, gold steadied as investors weighed a decline in global equities, unease over lofty tech valuations, and fading expectations of an interest rate cut in the U.S. Here, Bloomberg is pointing to the broader macroeconomic environment. Gold isn't moving in isolation. It's responding to global equities, tech sector concerns, and the trajectory of U.S. interest rates. All of this combined explains why the price action might be calm at the moment, despite underlying tensions in markets. Peter Schiff notes, with $4,000 holding as gold's new floor and silver support now being $50, informed investors are seeing the writing on the wall. Precious metals are holding their value after the spike in early fall. Capital is rotating toward real safe havens and cash-generating miners. Schiff is emphasizing two things here. First, he sees these levels, $4,000 for gold and $50 for silver, as psychological and technical supports. Second, he highlights a broader trend, capital rotation towards safety and tangible assets. This is a narrative about preservation of wealth in uncertain markets. Jesse Colombo comments, gold and silver miners are by far the most promising investment opportunity of the next decade, and despite their recent rise, they're still deeply undervalued with much more upside ahead. Colombo's focus is on the mining sector specifically. He's pointing out that beyond the metals themselves, companies extracting and producing these metals can represent significant potential, especially if they are undervalued relative to their long-term prospects.
Walter Bloomberg reports, central bank gold buying surges. Goldman Sachs says central banks likely stepped up gold purchases in November, continuing a multi-year diversification trend. The bank estimates buying rose to 64 tons in September from 21 tons in August and maintains its forecast for gold to reach $4,900 by end 2026. Spot gold traded near $4,068 on Monday, up 55% this year on geopolitics, ETF inflows, and expectations of further U.S. rate cuts. Looking at this closely, Walter Bloomberg is highlighting the massive central bank demand for gold, which reflects long-term strategic diversification. The surge from 21 tons to 64 tons in just 1 month is significant. Plus, the year-to-date 55% rise shows how geopolitics, ETF flows, and interest rate expectations are driving market behavior. Goldman Sachs's $4,900 forecast underlines a cautious optimism for the medium-term trend. The Great Martis says, gold, a big move is pending for gold. A large symmetrical triangle now look like forming. Next few days will confirm. Here, Martis is pointing to technical analysis signals. The formation of a large symmetrical triangle typically suggests consolidation before a decisive breakout or breakdown. Watching these patterns over the next few days will be crucial for understanding potential near-term price movements without implying any action is required. Ole Hansen notes, gold declined for a fourth consecutive session, again drifting toward USD 4,000, while silver slipped back below USD 50. Both continue to feel the weight of equity-driven risk aversion, where rising volatility forces leveraged positions to be pared back. In addition, fading expectations for another U.S. rate cut next month are also weighing on sentiment. This insight balances the previous optimism. Hansen highlights the short-term pressures on gold and silver from equity market volatility and changing rate expectations. It shows that while the long-term narratives may be strong, short-term market dynamics still create fluctuation and risk. So, taking all of this together, the commentary presents a mix of long-term strategic interest, technical signals, extreme upside potential, and short-term market pressures. Gold and silver remain highly watched assets with multiple factors influencing them simultaneously. Remember, this video is for educational and commentary purposes only. Nothing here is financial advice. Always conduct your own research and make decisions that fit your individual circumstances.